everybody, and welcome back to the Dash Trader Newsroom, right in the middle of a market meltdown. How low can we go as the market continues to melt down on this April 4th of 2025? And my name is Michael DeGioia, Director of Educational Services here at Dash Trader, joined by my co-host, Jill Malandrino, Global Markets Reporter at Nasdaq. Jill, how are you?
Good. Happy it's Friday, although who knows what can happen over the weekend.
Exactly. These markets have certainly been dicey lately. And, as you can see here, we've kind of completely retraced the move from, the move up that started in August of last year and really got accentuated on President Trump's, presidential victory. But now that all of those losses have been erased, the markets have suffered their worst loss since 2020. But how low can this sell-off go? Any thoughts just coming out of the gate here?
It's so interesting. I just did a segment before with two volatility traders out of Chicago that I've known even before I was in media. And one of them brought something up that was interesting because we were talking about valuations. And to your point, Mike, where there was such a run up from the inauguration up until, let's call it mid-February. And if you remember in the beginning of the year, the trade really was for European equities because of the valuation and the risk was to the upside, right?
Mm-hmm.
So that was in place even before uncertainty entered the market. And I remember talking about it that, the outperformance between European equity, European emerging market equities versus US because of that risk to the upside. So valuation clearly, regardless of what's happening, with the uncertainty around tariffs and policy strategy and so forth, that valuation play was somewhat in play. Clearly this accelerated it. But the point that, the vol trader I was speaking with had mentioned, if you look at the historical, multiple on the S&P and the Nasdaq 100, there is still more room to the downside when you're thinking about it just exclusively through the lens of valuation and multiples. So there's a couple things to unwrap here. One, you have to recognize over the past 15 years-ish that there was so much liquidity in the system. Policy was so accommodating that perhaps the way that US markets have moved was also because of the macro environment. Because you have to remember, Fed policy has certainly been more restrictive than it was in the past. And that could potentially be part of it as well, even though companies, many of them fundamentally been doing well, operating well, some of them deserve those multiples. But, if you think of it just strictly through that lens and remove, tariff conversation, we are still, in fact, overvalued if you think of it from that perspective. I think what the challenge is here and why I think it's different this time, I know no one likes that phrase. In 2020, we knew what the issue was, right? We already, that was 2 years after the first, tantrum with in December 2018 when we started the whole trade war thing there. We knew that there was going to be some sort of a resolution to COVID. That was the issue. We were able to identify it. This is different this time because it's not isolated to one thing, and it's not just about the markets or the economy. This has reverberating effects as it relates to our national security, our allies, what trade is going to look like, how alliances could or could not be made. So it's not as if it's just one event that we can identify. The calculus of everything changes. And I think that's why, there is a prolonged period of volatility, and we're still trying to figure out, okay, I don't even hear anyone talking about the bottom. Which to me also suggests that as a longer term investor and being diversified, these are the lessons that you learn and there's a reason why. So that is the silver lining, but you're not hearing the bottom yet or buying the dip or none of those kinds of conversations that we've had in the past, Mike. And I think you and I have been pretty clear that, as a longer term investor, there will be opportunities and there's a reason why you're diversified. And as a day trader, I wouldn't even say swing trader. I'm not sure if I would hold anything overnight, but there are some opportunities there in this kind of environment as well. I think not that we were being bearish or bullish. We were talking more about the opportunity you can pull from this.
Yes. So like a couple of things. So we are almost in bear market territory. I believe the Russell 2000 actually did enter into bear market territory. Bear market territory, just for people who don't know, is a 20% move, a greater than 20% move off the market highs. And then you have some, kind of glimmers of light, which we've talked about a couple of times. That Trump did come out with a book many years ago called The Art of the Deal. And Trump is the great negotiator. And, there were claims that Trump had negotiated a deal with a country like Vietnam. Case in point, Nike was bouncing a little bit, or possibly showing some signs of coming back to life after a very steep slide. So, there are signs that this is going to be a prolonged period where the United States negotiates or renegotiates, under the kind of negotiating stick of tariffs. So, tariffs continue to be a negotiating technique. Now, do you think that this is something that is, a good possibility that we're just going to see, Trump go through country by country, economic group by economic group, renegotiating the U.S. relationship, under the kind of big stick of tariffs?
So, well, I think the extremes with proposed tariff strategy as it stands right now is very, it's akin to what it was prior to World War II and when, things became more globalized, right? And we saw how that did not play out as well. I think at least for the next 3 years and 9 months, 10 months, that the tariff tactic will not, I don't know if it'll be leveraged. I can't make that prediction, but I think that's kind of always going to be out there.
Yeah.
This was something else that we spoke about on the segment I did prior to joining you. If you're the CEO of these automakers, right, you don't just pick up your manufacturing, put it somewhere else, and tomorrow you're manufacturing, in Texas somewhere, right? These
Yeah.
kinds of projects, when it comes to infrastructure, when it comes to data centers, when it comes to anything that is utility related, manufacturing related, supply chain related, they're capital intensive projects that take a long time. And it's not even just because of the physical construction of it, but then you have to go through, all the red tape to get the permits and all that kind of stuff. So do you, from an operating perspective, make all these investments knowing that this could completely reverse in a couple of years by the time that your facilities have moved elsewhere? And then how do you think about that calculus again? So it's got to be, it has to be challenging. And it's not just about, I'm using the automakers as an example because I think it's the most relatable. But you have to remember, too, there are Americans that work for foreign car companies where their manufacturing is here. So it's going to hurt them. Even, I don't necessarily agree with the way, Elon Musk has gone about his execution in his role in the administration, but I do not for a minute support anything that has been done to the dealerships or to people that own Teslas out of spite for Elon Musk. It is
It's
horrific as a
misdirected.
human
Yeah.
being. It is horrific as an American. Those Americans that work in those dealerships, those Americans that drive those cars, do not deserve that. That's the one thing
Absolutely.
we should be unified about. So I
Yeah.
think, just because you move things that are technically based in the US, there are Americans that work for foreign companies that are on this soil. So it's someone's going to get hurt somewhere.
Yes, absolutely. And I totally agree that misdirected anger or angst is never appropriate. I mean,
Oh,
there's a lot of misdirected anger and frustration going on, which is actually evident in the market as well. Which brings me to my next set of talking points here. The markets are forward looking, okay? There are some structural weaknesses that are showing in the US. I mean, are there some structural weaknesses showing in the US economy today? We had what would normally be considered a pretty strong March jobs number. We had 228,000 new jobs created in March, but unemployment still ticked up to 4.2%. So besides for the new tariffs, what else has structurally changed? But it just seems like this is a forward-looking reaction to all the trouble that we have ahead in kind of restructuring manufacturing and moving it from a globalized market back to a more, American-centric market. What are your thoughts on
Um,
that?
well, I wish I had something more constructive to say. I think, and yes, the job number was a surprise this morning. And it's interesting. If it wasn't good, does that mean that the Fed gets more dovish? Since it is good, does that mean the economy is still able to hold its own? I think that's really what the wild card is, not the wild card, but the variable that will make the biggest difference. If, in fact, tariffs get passed on to consumers, it's going to make things more expensive. Well, if they're not working, and 70% of our GDP is derived, from consumer spend, then things, then that's when things start to get tricky. I will say, however, though, I mean, we're such a services-based economy
Mm-hmm.
that, I don't know how that, and that's why it's confusing to me with what's happening with some of the tariffs, and then also violating some of the trade agreements that we actually have. For example, I forget which economist had pointed this out, but South Korea, as an example, with which we have a trade agreement, they're not trading 50% tariffs on U.S. exports, nor is the U.S. charging a 39% tariff.
Mm-hmm.
So, you know, I don't understand the strategy, and I'm not saying that to be flippant, but I think a lot of economists are um, having a hard time trying to piece this together as well, because the reciprocal, it's not really accurate. And it's such a head scratcher that you come in with such a strong economy and things are kind of operating on all cylinders. Whether it's the market, the economy, and it's hard to wrap your head around how it could get off the rails the way that it has in just 2 months. And Mike, I shared this story with you going into the
Yeah.
election. It was an Uber driver, or I believe it was an Uber driver, where he was saying, and of course it was right around the election, so everyone's talking politics, that um, because the economy and the market's been doing so poorly, he thinks Trump will turn it around. And I was like, with all due respect, S&P 500 was up nearly 30% the year before. Your 401k is performing better than it ever has. We're at nearly 4% unemployment at that time. What, that's an anomaly. That's not, how it typically works. So, um,
Yeah.
I think the messaging and how people understand the markets and the economy, is misguided.
Yeah.
So, I just, yeah,
It's kind of mystifying. It is, and I know
yeah,
I've been bumping into a lot of people who don't necessarily understand what's going on as well. And
yeah.
to be even with my 26 years of market
Mhm.
experience, and I just brought up the monthly job creation numbers, which we can see they're they were surprisingly back to the upside, which is positive for the economy. Sometimes it's hard to get a handle on what's going on. There's a number of factors that are in play, and one of them is something that you and I have been talking about pretty much nonstop since the
Mhm.
pandemic, which is inflation. Inflation has been a constant problem, and for different reasons, right? So, in the Biden administration, we had a lot of inflationary problems due to large assistance that was granted kind of to help the country recover from the pandemic. Lots of money in the economy, lots of created money. Fed created, kind of fiat dollars in the economy will have a tendency to cause inflation, and that was pretty much coming under control. And now we have a new cause for inflation, which is the new tariffs that have been put in place. So Fed Chairman Powell said that inflation, as would be expected, is expected to move higher as the tariffs are put in place,
Mhm.
but that as of right now, the Fed was taking a wait and see approach. Now, in a reversal of his, prior statement that the Fed did not need to cut rates, Trump, there was a soundbite today that Trump had said that the Fed could cut rates, but that the Fed is being political. Which is kind of sounds kind of par for the course.
Right.
Needless to say, what is your take on whether the Fed is being political or not, or if they need to take a wait and see approach? I mean, it's seems pretty straightforward to me that we're going to see some inflation as a
Yeah.
result of tariffs. I mean,
So,
it's almost undeniable that if you add 20 or 25% to a product that's being imported, that you're probably going to see inflation of some kind.
yeah. Well, I mean, I don't recall the Fed being as politicized, not by actions of its own, um, until Trump 1.0, right?
Yeah.
There was always that understanding that the Fed is apolitical. They are not, part of the Treasury. It's its own agency, if you will.
Hmm.
So the fact that it's trying to be politicized again, and now that's in everyone's head, right? Is not surprising to me. I think Powell, when he spoke today, was 100% correct in saying we do not comment on policy outside of the Fed. We are not a political agency. If the market doesn't like it, too bad. It's not his mandate to make sure, the market
Yeah,
goes up every
I
day.
agree with you. I think that
Yeah.
Fed Chairman Powell needs to take a wait and see approach until it actually shows
Right.
up in the numbers,
Well,
as
and
opposed to just, making decisions on speculation. I mean, that's
right. I
not
mean,
what the Fed's job is.
you just said it before with Yellen. She has a set of data points that she looked at, and that was her benchmark. It's the
Yeah.
same thing here too. We need to, and again, not to get into political conversation and how the structure of our legal system works, but these institutions, this is literally the only thing that's holding us together.
Yeah.
And because there's such lack of understanding and civics isn't taught in this country, again, totally different conversation. Nobody
Hmm.
understands how the structure works. So couple thoughts here on inflation, which this time around will be self-inflicted wounds. I think the shock that consumers went through during COVID, um, and I think a lot of companies rose prices towards the tail end of that once we were out, of the pandemic. And you see shrinkflation and I think some companies perhaps may have taken advantage of that. I can't see in any scenario where consumers are going to be understanding, or even if they think it's transitory, which I don't think it will be. The ones from COVID certainly weren't. Um, it's going to be hard to balance for companies trying to pass along because of what consumers went through in COVID. It's going to be an exercise for like the communication teams at these companies. It's adding on
Yeah.
another 20%, the US consumer, if even if you're trying to get rates down so that housing opens back up, guess what? We're never getting back to 3%, right?
Yeah.
No one's going to refinance when, what is it, 40, 50% of mortgages are under 4%, right? That's not
Hmm.
going to happen.
Yep.
So affordability doesn't necessarily change. Then you have day-to-day stuff that's 15, 20% higher. How is that going to help people buy a home? So
Yeah.
it feels very self-inflicted.
Yeah. I mean, there's a, I was reviewing some of my notes, funny enough, over the course of the last 2 days. And I remember doing a presentation back in 2008, 2009, and 2010. And around that time, this was just before the kind of, emergency aid was done for the financial crisis, that the federal budget deficit was around $10 trillion.
Hmm.
And you had mentioned earlier that we had 15 years of really favorable Fed policy and liquidity being pumped into the market from both the U.S. government and from the Fed. And you can see it if the federal deficit in 2008, 2009 was $10 trillion, and it's near 37 trillion now. You could see that money has inflated the U.S. economy, and that money that was created went somewhere, and that much money being created tends to create inflation. Now that spigot is being turned off, very abruptly, with the addition of a major structural shift in the way the economy is being handled.
Mhm.
And, that sets up for a really, really difficult, almost, a perfect storm, so to speak, for an economic recession, or even, or even worse, dare I
Yeah.
say, depression.
I
So
think, I'm sorry, go ahead.
go ahead. No, go ahead.
No, I also think, and I could be wrong and totally misinformed. I also feel like it's hard to discern who's advising Trump as compared to the first time, from an economic and fiscal perspective. I can't really put my hand, like my finger on it.
Yeah,
Like Mnuchin was very present, and some of the other senior people in the administration. It, I can't figure out where this tact is coming from, or um what the end game is, right?
yeah,
And I think that's also what the market is struggling with. It's hard to identify, like, not only what the strategy is, but who's in his ear. You know what I mean?
yeah. I mean, where are these the market policies? Where are these policies coming from? Because usually
Right.
you could, like, I remember in Trump 1.0, it was,
Mhm.
Kudlow, right? Larry Kudlow was was kind of in Trump's circle, but at this point in time, there's not like a go-to person, that you can see as a front person who's kind of advising Trump in his economic matters. This time, it's kind of a little bit more nebulous, to say the least.
Good word. Yeah.
Yeah. So on that note, I'm going to jump into the technical element of this. There's a lot to talk about technically,
All right.
because we came right from, market resistance right to the most recent area of support. So on that note, Jill, it's great to get your insights as
Thank
always.
you. All right. Have a good
Thank
weekend,
you.
guys. See ya.
Till next time. See you soon. All right, let me jump it right in here, and I'm just going to advance the slide as we jump to our market analysis section, and hopefully my charts seamlessly pop up. So here we have it. I mean, this is the QQQ. As you can see, the market ticker is streaming right there alongside. We got an hour and a half to market close on this Friday. Markets have pretty much, they made a recent new high, um, back in February. It was a shallow new high. Market dropped, bounce. That would be a dead cat bounce, which we actually talked about in our newsletter. And then here we have a drop. We also included that this would be the level that the markets would drop to, in which would take us into bear market territory. And sure enough, here we are with the bounce and then a secondary drop. Now, more than likely, there'll be some kind of bounce at that major level of support, but I'm actually going to go back a little further using my Dash Trader charts, and I'm going to pull up 2022, and we can see that we've come so far up that if the market does not bounce, right, and cuts right through this next level of support, on the Nasdaq, the next level of support is down here at around 410. We're at 426 right now. So here is 410, as probably the next level. The next level down after that is 400. And then you go even further, the ultimate kind of wipe out the entire 2023 into 2024 market rally would be to take us all the way down to around 350 area. That would wipe out pretty much everything the market did, and that would be firmly in bear market territory. Now, usually in a bear market, you get very sharp rallies and then, sudden declines. But let's look at some other key stocks like NVDA, NVIDIA, or NVIDIA, is back below 100. So anybody who thought NVIDIA, was going to be impenetrable. I mean, Nvidia showed this sell-off before other stocks. It was a market leader and is clearly a market loser now. Meta also, showing a little bit relative strength to the rest of the market, but with a clear head and shoulders pattern, right? From 2020 into 2020, from 2022 going all the way to current. but a very, very clear head and shoulders with a neckline break. Let's go to Goog. And Google is relatively weaker than the other Magnificent Seven stocks. So Google showing some relative weakness. We got Apple. I say Apple is a rotten apple. Apple has some real structural problems on its hands. Most of its manufacturing is done abroad. And certainly, Apple has some other problems related to it. So, meaning just competition from, cheap competitors. The good thing that Apple has going for it is that it is kind of cult-like, has a cult-like following. People who love Apple, it's very unlikely that they don't know how to use another technology besides Apple, no less will readily switch, which is a good thing for Apple. NFLX. Finally breaking. Netflix was showing relative strength far longer than any other of the big Magnificent Seven. MSFT, Microsoft, really relative weakness on Microsoft. Microsoft topped out back in December and is definitely in what we would call a stage 4 downtrend. It's downtrending steadily. So Microsoft is definitely showing relative weakness. Even if you look at stocks like GE, was in a steady uptrend and, has now broken that steady uptrend and has, its uptrend is broken. So, I mean, it's not broken the sideways trend because there still is some sideways trending action that you can see here. I'm just going to see if I can snap an array line here to show you where the sideways trend, but it's right close to the break of the sideways trend as well. So that would be GE. XOM. XOM as well, starting to show some weakness. It had been in a sideways trend, but it's kind of moved to the bottom of the range. Companies like Ford, bottom of the range. GM also at the bottom of its range. Obviously auto manufacturers who manufacture in other countries, they have some structural things that they have to deal with. Some are better off than others. US Steel holding up okay. Alcoa, also affected from, they're a mineral producer or, so obviously they're at the bottom of their range. Let's just look at the DIA overall. The DIA double top, consolidation, drop, and there it is a breakdown. But needless to say, definitely in, looking very bearish. SPY also looking bearish. I mean, the SPY's chart already broke. So what was support on the Nasdaq, so Nasdaq has not broken its support, whereas the SPY has already broken support. So the support level has been broken. So, we might rebound, but it looks to me like, if it closes below that level, then that would be considered a break of support on the SPY. So we are looking like we are in market meltdown mode into stage 4, at least on the S&P and on the Dow. Nasdaq has not broken that key level of support yet, but we're definitely looking like we're in market meltdown zone. Anyway, let's jump back to our slides here. Stay up to date with all things DAS by signing up to our monthly newsletter and email. Simply fill out the form at the bottom of our webpage at www.dastrader.tv, www.dastrader.com. Subscribe to our YouTube channel, DAS Trader TV, and DAS Newsroom Reminders. Follow us on social media and LinkedIn, Twitter, Facebook, and Instagram. I would say traders, be careful out there, trade well, and realize that market volatility gives wonderful opportunity, but also you need to always keep in mind your risk rules and not risk more than you're willing to lose. And certainly be careful about staying and holding positions. If you are a long-term investor, get ready to batten down the hatches. This is going to be a doozy. All right, everybody, trade well, everybody. Till next time. Bye-bye now.